Welcome to Yahoo Finance Live. I'm Shauna Smith along with Jared Blickery. It is a final hour of trading for the year. Stocks extending losses this afternoon. You can see we're in the red, where we have really been for much of the last 12 months. You're looking at the Dow off 324 points, S&P off just about 1%, as well as the Nasdaq. And Jared, it has certainly been a brutal year for the markets. All three of the major averages on track for the worst year that we have seen since 2008.
Shauna, this has been a year of elevated volatility. And let's just take a look. This is the fifth day of the Santa Claus rally, which officially carries into the second trading day of the new year. That's going to be next Wednesday. Next Monday is a holiday. Thank goodness. Here's the last 5 trading days. And guess what? If you're wondering where Santa Claus is, so are a lot of investors. Dow underwater, but not by much. 38 basis points, less than 0.5%. S&P 500, slightly negative as well. Almost the identical return as the Dow. And then the Nasdaq Composite, that's down 1%. And then checking in on the sector action for today, only energy in the green. You can see that's XLE over there in the upper left. And then real estate and utilities, those are the two worst performing sectors. Those are defensive sectors, and so those are taking it the most here. But let's check out what the 5-day look is. Again, energy at the forefront, that's up over 3%, followed by financials and communication services. But it's materials, tech, and staples that have been sold the most, along with healthcare. And interestingly, healthcare, staples, and materials have seen a rise. Those have been some of the favored sectors this month. Let's take a look at the Nasdaq. This is over the last 5 days. You're going to see a lot of red and dark red here, and we'll get into some of that in a few minutes. But here's the intraday look. Tesla just barely breaking even. Netflix up 0.25%, but for the most part, just mild red here. Not a lot of heavy selling, but just some listless sideways action or sideways to down action in a lot of these stocks. Shauna.
Certainly has been a rough day, a rough week, a rough year for the markets. Jared, let's also take a look at Southwest, because that has been a huge story this week. And for the week, the last 5 days, looking at losses of nearly 6%. Now, the move to the downside coming after thousands of flights have been canceled over the last several days, throwing holiday travel into chaos. But there is a bit of good news today for the airline. Operations have returned to near normal levels. The airline has canceled only 43 flights today. That's compared to over 2,300 yesterday. These numbers are all according to FlightAware. The flight tracker also showing no cancellations for tomorrow or for Sunday at this time. Now, the Department of Transportation is planning to investigate this disruption. A Southwest official saying that there certainly will be an impact to Q4 results, as according to multiple reports. A prior cancellation issue last year in 2021 cost the airline $75 million. We will see, though, what this massive disruption will cost the airline this time around, Jared.
And now let's get you up to speed on some news out of Washington. A House committee, after a years-long battle, it has released former President Trump's tax returns. The 6 years of returns provide thousands of pages worth of insight into the tactics the former president used to avoid paying taxes. We're going to have more on those returns in just a few minutes.
All right, well, let's get to the broader market action, some of the selling that we've seen over the last several months. Talk about what that could signal for the new year. And for that, we want to bring in Octavio Marenzi, Apimas CEO. Octavio, great to see you again. So another day of selling here, although the selling has not been nearly as bad as what we have seen over the last several months. Just your takeaway from the losses of this past year and what this signals as we head into the new year. Octavio, can you hear us? All right, we are going to get it worked out here with Octavio. But Jared, in the meantime here, taking a look at these losses, I think investors are certainly very excited to wrap up 2022, look ahead for 2023. But a lot of these projections that we're getting from some of the most well-known analysts on the street are saying things might not improve, at least right away.
No, I don't think so. And a number of headwinds still on the horizon. The war in Ukraine kind of took investors by surprise last year. That could be set to reaccelerate. We got some guests we're going to talk to about the potential for that, but also the other headwinds. We got a Fed meeting coming in at the end of the month here, at the beginning of February. Lots of expectations for that. The Fed expected to dial down its rate hiking bonanza here, but even though it's slowing the pace, it's really not even anything close to a pivot. So I I've seen some analysts expecting a recession in the first quarter, the second quarter of the year. Goldman Sachs doesn't think there's going to be a recession. In other words, they think there's going to be a soft landing. But let's go to the Wi-Fi Interactive for a second here and just check in on some of the leaders that we're seeing here. One of the things I noticed was, first of all, in terms of volatility, the last 3 days have all seen more than 1% moves in the S&P 500. That's not supposed to happen, Shauna, at the end of the year. They were supposed to have low volatility. We're not supposed to think about the markets, but you take a look at the selling that we've seen over the last 5 days in this heat map right here. At the very bottom, solar energy, which I consider kind of a fringe investment. That is, it's not, it's more of the speculative, more of the high beta investment. That has taken the biggest hit here, followed by meme stocks, biotech. ARK is the disruptive force. MJ is cannabis. So a lot of these fringe sectors, money getting sucked out, not the best risk on mood. So again, going to be interesting to see how we begin the new year.
Yeah, it certainly will be. And of course, when you take into account everything that has happened over the last 12 months with stocks and bonds both down simultaneously, I think a lot of that bad news will likely stay with us, like you're saying, just in terms of the Fed projections, what we could potentially see for volatility, at least in the first half of the year. Because when you take a look at those economic trends, certainly we are seeing signs of the economy weakening. The big question, though, is if we will get a recession, and then, of course, how deep that recession could potentially be.
Exactly. Well, we're just getting started here on Yahoo Finance Live. Coming up, former President Trump's tax returns have been made public. We're going to break down some of the biggest takeaways and lingering questions. Then, an industry insider gives his predictions for 2023. Among them, Meta could spin off its VR business. He explains. And perhaps no stock this year has been in the spotlight more than Tesla. See if a bounce back is in store next year. Don't go anywhere.
We've got about 50 minutes to go until the closing bell, and you're looking at losses once again with equities moving lower on the final trading day of the year. You're looking at the Dow off 263 points. For more on the market's losses, we want to bring in Octavio Marenzi, Apimas CEO. Octavio, great to have you. I think we got the audio worked out here. So let's try all of this again, because we are coming off what has been a brutal several months for the market. Investors looking ahead to 2023. Is it going to get any better?
I'm afraid I'm going to be a harbinger of bad news. I really don't see what's going to change or what's going to be fundamentally different. I mean, the story in 2022 was basically the Fed hiking interest rates and killing off and choking off the equities markets and the bond markets, and by implication, a bunch of other markets in the process as well. Inflation pressures are still there. The Fed is still going to have to increase interest rates further. They're not even close to their target inflation rate. I think more interest rate hikes are coming. The market consensus seems to be we're going to hit about 5% in 2023. I think that's mindlessly optimistic. They're going to have to go much further than that. I don't believe the peak interest rate is only 75 basis points away if you look at where inflation is. So I think there's more pain to come in 2023. I think we're going to basically see a replay of 2022, the same kind of pressures, the same direction.
And Octavio, is about a month or a month and a half into 2022, the current year that we saw kind of out of the blue for most people, a war emerged between the Ukraine and Russia. And I'm just wondering, I'm reading through your notes here, you think there's a chance for escalation, re-escalation again at the beginning of this new year?
Well, I think that the Russians have pulled up a very large army now and have put about half a million men right along the border along Ukraine. I imagine they're there to do something. And unfortunately, I suspect, and a bunch of military analysts are looking at, I'm not a military analyst, but basically looking at and saying they're probably waiting for the ground to freeze when their tanks can roll over that Ukrainian mud, which otherwise the tanks would get stuck in. Now, the weather's been unseasonably warm in Ukraine. Usually it would have frozen the ground by now. It hasn't. It's pretty warm. It's pretty muddy. It's pretty wet. So they're probably going to wait for January or February when the ground really freezes, like they did last year, and then roll in. And they've amassed this huge army that's going to do that. And I'm afraid it looks like it's going to be bad. But we'll see, I think, the same impact on commodities markets and bond and equity markets as we saw in February of 2022 as that escalates again. And I think, unfortunately, that's what's in the cards for us in the next couple of weeks and months.
And Octavio, with investors out there trying to figure out what they should do with their portfolio at this point, what are you advising your clients?
Well, basically, I mean, it depends on their risk profile and what they're kind of looking to do and achieve. But I think by and large, we've advised people to sort of sit on the sidelines and hold as much cash as possible and then wait for the central banks to reverse policies and pivot into a different direction, start to say we're going to start to decrease interest rates again and up the markets that way. But I don't see that as being close. I think all the indications are that central banks around the world are moving more into a direction of more aggressively increasing interest rates. Now, we've seen the Fed sort of lead the charge there over the course of the past year. The European Central Bank is starting to gain some momentum there and feeling inflationary pressures as well. The Bank of England has been in that direction as well. And finally, most recently, the Bank of Japan has been a very, very dovish central bank, is making the turn as well in terms of higher interest rates. So this seems to be sort of coordinated effort, except for the Bank of China. All the others seem to be moving in the direction of higher interest rates, and that's going to choke off markets around the world.
All right, Octavio Marenzi, always great to have you. Thanks so much for breaking down the latest on the markets for us. We want to get to the other big story of the day. That's 6 years of former President Trump's federal tax returns have been made public after years of wrangling. The House Ways and Means Committee releasing the returns from 2015 to 2020. Yahoo Finance senior columnist Rick Newman is here with a closer look at those documents. And Rick, I know it's thousands of pages of those documents, but I think the big takeaways: former President Trump paid very little in federal taxes during several of those years. Of course, he claimed some of those huge losses that helped limit his bill. But what stuck out to you in these thousands of pages that you've been able to parse through so far?
Right. So the caveat is it's going to take a while for tax experts to figure out what's really going on in these returns. And these are not all of Donald Trump's returns for these 6 years. These are his personal returns. And returns for a few of his business entities. There are other business entities not included here. But what I noticed as I was looking through this is year after year, Trump's bottom line for the one major business that's included here, which is called DJT Holdings, he declares massive losses at this company, 8 figures every one of these years. So in the tens of millions of dollars per year. Now, that is plausible. There's no reason on the face of it to say that this is illegal or anything like that. But let's go back to how Trump got elected president in the first place back in 2016. I remember, I mean, he ran as a businessman, not a politician, an outsider. And he told everybody that he was a great businessman and that he would go to Washington and he would be able to shake things up and fix things because he knew how to fix things as a guy who runs a complicated business. Well, let's say his tax return for just 1 year, 2015, had become public back then. That does not show that he's a great businessman at all. It shows he lost, tens of millions of dollars in 2015, and that pattern continued for the next several years. And then when you carry that over into Trump's personal returns, this is mind-boggling to normal people. So in 2015, Trump's adjusted gross income, his AGI, was negative $32 million. So for his income, he said he lost $32 million. And then for 4 of the 6 years between 2015 and 2020, his AGI was negative, and it was only positive for 2 of those years. And when you add it all up, it's deeply negative. So it looks as if Trump, on his personal returns, lost $54 million. $53 million between 2015 and 2020. How is that possible? I mean, normal people cannot understand that, because you can't just lose money in terms of your income year after year and get by. Now, Trump is able to do this because he carries these losses from long ago. You're allowed to do this in the tax code. He carries these losses from 5, 10, 15 years ago forward to help him offset other types of income that he gets in these present years. But this would have been very complicated to explain to taxpayers. And remember, it was very close in 2016. Hillary Clinton did publish her tax return in 2016. She made about $11 million, she and her husband Bill. And they made a lot of money, but it was very straightforward. They paid an effective tax rate of like 34%. You could look at the 2 pages, the top of the return, and it made sense. Not the case for Trump.
Well, Rick, just to play devil's advocate, wasn't that a pillar of Trump's campaign, though, that the system is broken? He knows how to take advantage of the system by playing the tax system maybe against itself, for lack of a better comparison there. Wasn't that really a pillar of his campaign? And so by that metric, could it be that he actually was a successful businessman? Or is that too twisted a logic?
Well, this is a counterfactual, because it's like, how would this have been different if voters did get to see Trump's tax returns in 2016 or in 2020? But you're right, Jared. Trump actually said, yes, the fact that he pays little in taxes makes him smart. And we've had leaks before that have suggested or actually shown that Trump pays very little in taxes. And that is perhaps not so unusual for some business people, and especially for real estate developers who get some of the most generous tax breaks in the tax code. So I don't know how this would have gone over with voters. I think it would have perhaps been a minor vulnerability for Trump. But if you want to carry it forward and say, what does this tell us that we could act upon in 2023 or 24 or going forward? I think there's something very unsettling about somebody who lives a gilded lifestyle while declaring millions of dollars in losses year after year after year and paying almost no tax. So, the IRS is in the process of trying to tighten up on people who do not pay all the tax that they owe. And Democrats have made this a big selling point, and they appropriated an additional $80 billion for the IRS over the next decade. If you want to try to tighten up the tax code and get the people at the top to pay a little bit more, Trump's tax returns are quite an interesting guide for how you might be able to do that.
Very interesting. Of course, we will continue to follow this story. Like you said, of course, we will get revelations about this in the coming weeks. Rick Newman, as always, thanks so much. Happy New Year.
Same.
All right, coming up next, economic and geopolitical challenges are reshaping the oil industry. Our next guest telling us what this means for the price of crude in 2023. We'll be right back.
Welcome back. U.S. oil prices are on track for another year of gains, small gains, and that's despite tight supplies caused by Russia's war with Ukraine and weakening demand from the world's top crude importer. That would be China due to lockdowns. Joining us now for more is Lippo Oil Associates founder and president Andrew Lippo. Andy, great to have you here as always. I'm looking at your price target and where you think WTI and Brent are going to go. You're saying WTI could go to $90. That's about $10 above the current price, and Brent also a similar amount to 95. Just wondering what factors into your analysis here.
Well, we have a lot of things that are happening in the oil market. First, if we were to look at the demand side of the equation, the two things that the oil market is wrestling with is, number one, is the reopening of the Chinese economy as the lockdowns are eased. But I don't think that we're going to see a real big impact of that reopening until the middle of next year. But it could be worth about 500 to 700,000 barrels a day of additional demand. But on the other side of that demand picture is the fears of a recession, especially in Europe, as they're coping with high energy prices from natural gas, as well as high oil prices as they seek oil products to replace that natural gas supply from Russia. Meanwhile, on the supply side in 2022, the world has really been making its way through with strategic petroleum reserve releases in the United States as well as elsewhere around the world. And if we look across the year, that has really added about 750,000 barrels a day of supply. As we go forward, these lower oil prices that we've seen recently are going to impact the supply growth we're expecting in the United States, with the Energy Information Administration has been continually revising downward their growth forecast of increased supplies here in the US now to about 500,000 barrels a day, whereas one time several months ago was high as 900,000 barrels a day increase.
Andy, when you take a look at where prices are today, we have WTI crude just around $80 a barrel. We certainly have seen this movement to the upside over the last several days. The winter storm over the holiday, I guess, how big of a factor has that been for supply?
Well, this has been a pretty big impact, especially on refined products. At its peak, nearly 2 million barrels a day of Texas Gulf Coast refining capacity was offline. That's about 35% of the Texas refining capacity. So, of course, if the refineries aren't running, they're not making gasoline and diesel. When we think about on the production of oil, the blizzards in North Dakota took off about 300,000 barrels a day of production, which will slowly recover. But more seriously, on the natural gas side, we lost about 10 to 15% of our natural gas production throughout the country as the cold weather impacted those fields in Texas and Oklahoma all the way up through Appalachia.
Andy, I want to ask you about those sanctions that we were talking about a little bit, just touched on them against Russian oil. Those seem to be largely symbolic, and the net effect is that we do have oil, low-priced oil being piped into Europe from the Urals. But what do you see in the new year? If things escalate with respect to Russia, Ukraine again, could we get another situation where we see crude, at least momentarily, spike up well above your price targets for the end of the year?
Well, it certainly could happen because in 2022, we saw oil prices for WTI get to $130 a barrel. So there can be a significant amount of volatility in the oil market. We had the European Union impose their sanctions on Russian crude oil purchases starting December 5th. Now what I'm looking ahead to is February 5th, when the sanctions begin on Russian refined products, and more specifically on diesel supply, where Europe has been buying about 700,000 barrels a day of diesel from Russia. So there is going to be a scramble for new supplies to backfill those lost supplies that have been available out of Russia. And we're going to be looking towards new refining expansions and capacity coming online in the Middle East as well as China in order to make up the difference.
Andy, when you look over at what's happening in China, of course, we've had the surge in cases, lots of questions about how extensively, or I guess how much that could really hold back the reopening there. When it comes to the impact that you see that having on crude, could we potentially maybe not hit your target and actually end up below $90 a barrel at the end of 2023?
We certainly could, especially if the return of Chinese demand becomes a disappointment and the economic factors around the rest of the world cause a deeper recession than people are calling for. And you could actually see oil prices plummet. And we saw that happen in 2008 and 2009, as well as in 2014 and 2015, where we saw oil prices back in the $30 a barrel range and $45 a barrel range, respectively.
All right, Andy, always great to have you. Andy Lipow, Lipow Oil Associates founder and president. Happy New Year. All right, well, let's talk about the EV market, because the number of EVs sold in the U.S. this year has nearly doubled in a year. Yahoo Finance's Pras Subramanian joining us now to discuss the outlook for this industry. And Pras, what do you think 2023 is going to look like?
So, this year we're about 5% EV market share, right? So, and some people think by 2025 that'll be 11%. But I think the biggest way to get there is with cheaper EVs. And I think next year we'll see a bunch of cheaper EVs come out. Starting with GM, they're going to have their new Equinox, the entry-level SUV, for $30,000, which is going to be, I think, kind of a big mover when it does come out. The new Blazer, midsize, 40-ish thousand, that'll be a nice one too. But also the Silverado EV pickup. I know Dave, if he was here, he'd be very excited about this. The work truck version, exactly. The work truck version, that will be $39,000. That's what GM says. We'll see if that happens. But that's a nice, price for that kind of full-size pickup. Toyota, Nissan also with their new EVs coming out in the mid-40s. So I think we'll see a lot of these EVs that are reasonably priced for people to actually buy next year.
And Pras, the Inflation Reduction Act slated to take effect in the new year, and we've been talking about some of the vehicles that can take part in the $7,500 tax credit. With respect to that, what are we expecting from the IRA in the new year? So
yesterday we got a couple of big nuggets here, guidelines that the IRS had kind of laid out. Basically, they said some vehicles could qualify for the $55,000 normal vehicle exemption. That's a max cap, and then the $80,000 cap for SUVs and vans. So, for people like Tesla and GM, that was supposed to be a big deal. Looking at the guidelines right now, I want to look at the Model Y, for instance. They've said that the Model Y 5-passenger version is going to be under the $55,000 cap, but the 7-passenger version will be under the $80,000 cap. But both cars are identical in size. Both cars are all-wheel drive. It doesn't really make sense. Whereas the Volkswagen ID4 EV is another SUV. For some reason, the non-all-wheel drive version is $55,000 cap, and the all-wheel is $80,000. So it's a little bit strange, kind of weird dynamics there for the kind of categorization. But they'll probably get ironed out in the next year.
All right, well, we're going to leave it there. Pras Subramanian, thanks, and stick around. We're going to see you in the next segment. Coming up, Amazon has seen its stock price cut in half this year. We're going to discuss what lies ahead for the tech giant. Stay with us. Time for Triple Play. 3 stocks we're watching in the final 30 minutes of trading. Today we have Nvidia, Tesla, and Amazon. My pick is Nvidia, which reached a peak market cap, not this year, but last year, of $834 billion. It is ending the year at $359 billion. That is a drop of over $475 billion, or 57%. And not a lot of fun. Well, we do have a lot of fundamental news, but I want to get to our heat maps here and just show some technical analysis on a sector basis. So here we have the year-to-date view. Lots of dark red, pretty ugly there. Nvidia, by the way, in the lower left, that's down over 50%. And let me sort by performance. You can see the bottom row there, Intel down a very similar amount, almost 50%. Looks like Western Digital, AMD, Marvell, all of those significant losses here. Now, if you look at the quarter, we do see some green, but the month of December was pretty negative for chip stocks. They are very cyclical, very levered to the business economy here. And any bad news with respect to the Fed still hiking, anything with regard to persistent inflation, well, that weighs on this sector. You can see only AVGO, that's Broadcom in the upper left, that's up about 0.9%, Praz.
Yeah, Jerry, we had a guest on this week on chips and stuff and talking about how the boom-bust nature of the business, it's such a commodity. They overproduce, then they have too much supply. NVIDIA is a different story because it's a really kind of these high-value graphics chips that people really want. So maybe if these businesses go through that supply and then replenish later in the year, maybe it might be in a better spot. I mean, it's still a very expensive business to be in.
Yeah, it certainly is very expensive. And we've heard a number of the projections that have come out, not only from analysts, but a number of industry watchers. Gartner out with a recent forecast saying that the global semiconductor revenue is projected to decline 3.6% next year. So I know a number of analysts are bullish on the sector, but a lot of that has to do with picking the right winners in the space, given the fact that there's so much uncertainty headed into the new year.
Yeah. Another stock that I'm watching here is tech-oriented is Tesla. Shares a flap today, but poised to finish the year with its biggest ever decline, down a whopping 65% for 2022. That's a big ouch right there. Hard to believe the stock was around 360 back in March, but here we are. And as we know, CEO Elon Musk made his Twitter overture back in April. The stock has slid ever since. Elon's numerous stock sales, as well as demand concerns both here and in China, weighed heavily on the stock. However, we will have Q4 delivery numbers next week and the IRA tax credit back in effect next year. But my big question for next year is, will Elon get out of his own way? I think that's the big issue, I think, for Tesla and investors next year.
Yeah, and I don't know if anyone can predict it. I think you might be optimistic that he will prioritize Tesla and let somebody else run Twitter. We're going to be talking to Dan Ives in the next hour, and he was out with 10 predictions or actions that he thinks Elon Musk needs to do in the new year, and that, of course, topped the list. But I also think investors and analysts would like to see Tesla get more focused just in terms of the fundamentals. We talked to Colin Rush earlier this week from Oppenheimer. He was saying he is bullish on the stock because of its position from a technological standpoint versus where it has been trading and this overhang from Twitter, this distraction. So I think Tesla clearly has room to turn it around. How quickly they do it, though, is going to be the big question.
I think the only way Elon Musk is out of Twitter is if he's forced out because of financial reasons. I think that's the only comeuppance he's going to listen to.
We will see. And of course, we'll see whether or not he's forced to sell more Tesla stock to fund his ongoing efforts over at Twitter. All right. Well, my pick today is Amazon. Certainly has been a brutal year for the stock. It's lost just about half of its value in 2022, with hundreds of billions of dollars wiped from its market cap. Now, its market cap is now around $844 billion. Putting this into perspective, though, that's down from $1.7 trillion. This year marks the second worst year ever for Amazon, second only to the 80% drop that we saw in the stock during the dot-com crash. Shares today are trading just around $83 a share. That's about $1 higher from that 52-week low that Amazon hit earlier this week. Now, Amazon, though, certainly is not alone in the massive drop. 2022 has been a very tough year for a number of the larger cap tech names, Meta being one of those names, Jared, off just about 64%. So rising rate environment, recession looming, questions whether or not we are going to see the tide turn for tech next year. We heard from a number of our market guests, though, they're still advising to stay away from the sector, at least for now.
I was just reading Professor Galloway's column for the weekend here, and guess what? He likes big tech next year because of all the layoffs. Guess what? They're getting rid of tons, billions of dollars worth of headcount. The Twitter lesson that a lot of these tech execs are learning or having to notice is that you actually can run a platform, not necessarily well, based on cutting 2/3 of the staff. I think that's what they cut there. So I think, we could definitely see huge margins and record profits for tech, big tech this year, which means the stock might do well, even though the industry revenue may not be at its breakneck growth pace.
You know, we heard, I guess I read reports about Amazon's cargo planes being half empty, and they're selling that cargo space to kind of accommodate the air cargo volume. But you know, if I'm an investor in Amazon, I want maybe two things on my wish list, right? Buyback, a nice little juicy buyback, and then maybe spin off AWS. Is that going to happen? That could be a nice game.
Yeah, we'll see. I don't know.
I don't think so,
AWS,
but
though, their crown jewel. I don't know if they'd be willing to spin off, but we'll see. We'll see. All right, well, coming up next, our next guest is saying that 2023 could be a big year for business-to-business payment platforms such as Stripe. We've got the details for you next. It has been a brutal year for tech stocks, the Nasdaq falling more than 30% since the start of the year. It's the worst year that we've seen since 2008. Now, the drop coming as major sector players, including Meta and Amazon, have both lost more than 50% of their market cap. Joining us now to discuss the outlook for the sector for the new year, we want to bring in Cameron Ansari, Greycroft board partner and former head of M&A at Pinterest. We also have Yahoo Finance's Ali Garfinkel joining the conversation. Cameron, it's great to see you. So let's start with the sell-off that we've seen within the sector over the last 12 months. Looking out into the new year, do you think things are going to turn around?
I mean, I think so. Certainly, as we get into kind of Q1, Q2, the valuations should come back. And I think you're going to see some of these stocks that have been oversold, particularly in January, as investors get back into their chairs and start looking at these things and trying to figure out where there's opportunities. The mega cap names like Amazon, like Facebook, Alphabet, Apple, I think these names are going to have nice years. And they're not going to, get back to, I think, where Amazon and Meta were. They're not going to double. But I think you're going to see nice gains, maybe 15, 20, 30% in 23, as some of these names have been certainly oversold.
Cameron, Allie here. I'd love to start with the IPO market. You've identified SpaceX and Stripe as bellwethers there, I believe. Why, and what were you looking for from them as they potentially move towards an IPO next year?
Sure. Well, look, we had about 1,000 or a little more than 1,000 IPOs in 2021. 2022, we've seen basically half that number. So the market's been really quiet on that front. And in the tech space, I think you have a number of companies, SpaceX and Stripe, I think being the biggest and most anticipated, probably the most IPO ready, that have been thinking about it and putting things in place for years to be able to make that happen. But there are many others too. You have Instacart that has announced that they're going to come out. I think the CEO said we don't need a perfect window to come out. We just need a window, an opportunity. They're not looking for the perfect valuation. I think they've cut their internal valuation from 40 billion down to 10. And I think they're being realistic about the market expectation. And that's a business also that has $2 billion in revenue and has turned profitable. So I think they're well positioned, I think, to come out. And then all the other companies that are really in the pipeline, I think, in the tech space, other than Instacart, which is obviously more of a consumer e-commerce business, are very well positioned B2B companies. You have Databricks, which is a database management company, Arctic Wolf, these companies that are really more B2B software, Gong, which is a B2B kind of sales tool, Redis. And these are all, well-known kind of well-positioned companies that I think you're going to see probably IPO, maybe not in the first quarter or two of the year, but Q3 and Q4 for sure. I think you'll see some of these names start to come out.
Cameron, let's talk about the B2B space, because I know you have currently backed a number of companies within that industry, Credit Key, Hopscotch, Coast, just to name a few of those. Talking about the growth opportunity for B2B going forward, how do you see that?
Sure. Well, look, most of the companies that people are familiar with today, particularly the public companies in the fintech and payment space, you think about Stripe, which is not public yet, but obviously Square, now called Block, PayPal, Venmo, Braintree, Affirm. All these companies, what they effectively do is help consumers pay a business, or they help consumers pay each other. None of these companies really, at their core, help businesses pay other businesses. There are really only a couple of publicly traded companies that do that at scale. You have Bill.com, Coupa, which is just being acquired right now by Thoma Bravo off the public market, and maybe FleetCor, which is trucking and business payments in that department. But there are very few companies at scale publicly traded that do B2B payments. And yet, certainly on the e-commerce side, when you think about digital payments from businesses to other businesses, that's a much bigger market than consumer. So all these companies that today really power the infrastructure, the backbone of the consumer e-commerce market, which these days I think in the latest numbers it's like $4 or $5 trillion. That's obviously massive, but the B2B market is estimated to be double that or more. So I think you're seeing the opportunity really be to help businesses pay other businesses, particularly digitally and in an e-commerce kind of point of sale setting.
Cameron, talk to me a little bit about M&A, because much in the way that this year has been a slow year for IPO markets, it's also been a pretty slow year for M&A. You mentioned Coupa and Thoma Bravo. That's kind of one of the big marquee deals that sort of come out of the year. Yeah. What are you expecting to see in terms of deal making in 2023?
Sure. Well, look, I've actually been surprised that there haven't been more deals because you have a combination of a lot of dry powder, both in terms of the mega tech names like Facebook and Google and these others who have just giant cash stockpiles. And you have private equity firms with very large cash stockpiles of funds they've raised. And by the same token, you have valuation declines both in the public market and the private market. So, I think the opportunity is really right now in the coming months for us to see quite a few M&A transactions happening. And look, 2022 was not crickets. I mean, there were some, very, very large deals that were announced. Microsoft, Activision, the acquisition of VMware by Broadcom, many others. And these are large deals. Figma, which Adobe's looking to buy. These haven't closed, obviously, and the Activision Microsoft deal is now under some FTC review. So we'll see what happens there. But 2022 had a few, handful of these deals announced. But my suspicion is that going into the new year, Q1, Q2, you're going to see a number of additional deals announced, particularly from both private equity firms that operate in the tech space, like Thoma Bravo, like Vista, like Silver Lake, and these folks, as well as the large cap tech buyers themselves, like Amazon and Salesforce and Oracle and these companies.
Certainly makes sense with so many of these tech companies sitting on lots of cash. Cameron, I also want to get your thoughts on Meta, because like we were discussing earlier in the show, the stock's off more than 60% since the start of the year. A lot of investors are questioning this big bet that Zuckerberg and company have made on the metaverse. Do you think we might potentially see a pivot from this in the new year?
I think you might. I mean, I think the numbers even came out that the total sales of VR devices dropped, I think, 1 or 2% in 2022 versus 2021, which is surprising, right? When you look at all the buzz in that market, all the new devices that have come out, there is a lot of anticipation that in the new year you're going to get competition to Meta in this space from Apple, HTC, and Sony, each of which is expected to release its own kind of VR, AR device. So you're going to see increased competition. You're going to see, a market that's not really growing particularly well. And Meta has invested so much money in this space. I think in just the first 9 months of 22, they lost something like $9 billion on their VR division, which is called Reality Labs. So in the scheme of the overall business, this is, it's not going to cripple Meta, but it's really hampering their overall profitability. They went, on a quarterly basis in Q3, they had $27 billion in revenue, $4 billion in net income. The prior year, they'd had almost the same revenue, but double the net income. So I think the losses are mounting because of the Reality Labs division, and you can kind of attribute a lot of that, very clearly in Facebook's numbers to how they're performing. But Reality Labs is kind of a drain on the overall business, and it's not generating the revenue that you would expect it to.
Bold prediction, but we like it. We'll see whether or not it happens in the new year. Cameron Ansari, great to have you. And of course, Ali Garfinkel, thanks so much for hopping on here as well.
Thank you.
Well, coming up next, we're taking a look at crypto because the price of Bitcoin plunging this year. You can see it just below 17,000. But is there still a good reason for investors to invest in crypto? We'll have more on that when we come back.
Welcome back. From bankruptcies to declining prices, it's been a down year for cryptocurrency. Let's take a look at how some of the industry's largest digital assets performed in 2022. And we're going to start with the behemoth here. Bitcoin down 65%. And like a lot of risk assets this year, the highs were made at the very beginning of the year, and the lows are being made towards the end. Now, it's a little bit different with Ethereum. Ethereum bottomed in about the middle of the year. You can see in June here, and it hasn't made a lower low since, so maybe a little bit better on a technical level, but I have to put a 5-year chart to really show some of the important levels here. Back in 2018, when Bitcoin had its run up to $20,000, Ethereum peaked out at $1,500. This is a key resistance level, and I think this still carries a lot of weight, a lot of price memory. Ethereum going to have to push above $1,500 before I would get serious about getting bullish about it again. Similarly for Bitcoin, going to have to push above $20,000. That's 16.5 right now, so got some work to do. We'll have to see if that comes to pass, but let me just show you when I sort these by performance, some of the biggest losers here, not surprisingly, FTT token, that's related to FTX and the bankruptcy, down 98%, Solana down 95%, but I'm looking at Binance here, not even down as much as Ethereum or Bitcoin. Pretty interesting year here because Binance, of course, is the largest standing crypto exchange in the world, and I would say if the 180, if the 200 level to 180 cracks in Binance, could be a tough slog down for all of crypto.
Certainly something to watch. All right, Jared, thanks so much. Well, it has been a very, very tough year for crypto, but let's talk about what we could expect over the next 12 months. David Hollerith has been looking into this for us. And David, the biggest things that you're watching in the new year?
Yeah, the most optimistic sources I've spoken with have said that they expect crypto's bear market to continue through the first half of 2023, with retail investors largely staying on the sidelines. But front and center heading into next year, there's much anticipation, sort of waiting for, another shoe to drop in terms of crypto's collapse from 2022. And most are waiting for the one known company that hasn't really answered since showing signs of liquidity issues, Genesis Lending, which paused withdrawals last month following FTX's collapse. As we know, Genesis' parent company, Digital Currency Group, is trying to raise between $500 million and $1 billion. And if that doesn't happen, the company will likely file bankruptcy. The industry is also clearly in the process of rethinking corporate business models and governance, given how many of last year's star players have failed. Now, Binance and Coinbase have emerged as crypto's two largest centralized exchanges. And I'd argue that has made them increasingly important survivors for the industry. And the trajectory of those two companies is largely going to define what happens to crypto in 2023. And then on the other side of that, decentralized exchanges, or the DeFi area of the market, has always been said not to be as easy to use, but there's been a lot to be said about DeFi's resilience during this collapse. And that's going to be something to watch in terms of whether or not those DeFi protocols are taking market share from centralized exchanges. And finally, I just want to hit on Ethereum, which obviously had a success story with its merge upgrade. There's still more to look for in terms of updates on the protocol going into 2023.
And David, just thinking about the bankruptcy process in general, very protracted. We know, I think Lehman Brothers was only resolved a couple of years ago. What are we expecting from the legal side with respect to FTX and Sam Bankman-Fried?
Yeah, Jared, it's hard to keep track of all the cases, and I think speculating about a deadline for any of them has been sort of what all legal sources I've spoken to have sort of tried to avoid doing. But that being said, there are 5 different bankruptcies. And then also notably this criminal case of FTX founder Sam Bankman-Fried. Now, if we start from the first to last, the next conference for SBF case kicks off on Tuesday, and sources are waiting to see if Bankman-Fried will either plead guilty or not. If he doesn't, the court will schedule the agenda for next steps in terms of discovery, and that will mean likely a lengthening of the court hearing. And then in terms of the bankruptcy cases, we can't expect creditors to understand what money they will get back in 2023. However, there's going to be a lot more clarity to understand what rights customers actually have with crypto exchanges in terms of bankruptcy. So that's something we clearly want to watch.
Well, best of luck to all the customers out there. It could take a little while. David Hollerith, thank you for that report. Coming up, we're counting down to the closing bell on Wall Street. Stick around with us on Yahoo Finance Live. We are minutes away from the closing bell, and let's break down the market action. We're looking at a little bit of a rally into the close. Let me show you what's happening today. We are off the lows, and you can see not really off to the races, but I think investors will take a little bit of a pairing of losses here. And let's take a look at some of the sector action. We've seen energy leading all day, and it is still in the forefront here. Communication services about unchanged. Utilities and real estate, those are taking it to the downside, the most of the downside, off about 1%. And we've been tracking the action in the mega caps. A mixed board right now. We're seeing Apple showing some green, Tesla up 1%, finally snapping a 7-day losing streak yesterday. Not a lot of dark red, so we're not seeing a lot of selling right now. Let's take a look inside the Dow and see if we can see any trends going on. It looks like McDonald's down 1%. Let's skip over to the travel section. We have any travelers for the new year? Well, guess what? Booking up about 0.5%. Wynn Resorts up 1%. And Southwest Airlines definitely been in the news lately. That is up 0.9%. Here is your final closing bell of the year.
See some of the toasting to the last closing bell of the year. Many on Wall Street eager to leave 2022 behind us. You're looking at losses for the day and, of course, for the year. For the day, though, the Dow off just about 73 points, so well off the lows of the day. Nasdaq off just about 0.1%. The S&P in the red. But the markets, though, rounding out the worst year that we have seen since 2008, snapping a 3-year win streak. Jared, you have a closer look at some of these big decliners, and a lot of the selling really driven by some of those larger cap tech names.
Exactly. You look to the downside here. This is our S&P 500 spider sectors. XLC is communication services. XLY is communication discovery. That's what you were just talking. Consumer discretionary. That's down 37%. Real estate also taking a bit of a hit there, down 29%, and tech down 28%. So all of those put together really showing some of the negative action. What stands out is the energy sector. That is up 57%. That's a story about the Russia and Ukraine, as we've been talking about as well. By the way, oil pretty much round-tripped most of those gains. It's only ending the year up about 5%. I do want to show you one of the most important charts of the year, I think, is the 13-week T-bill yield. This closely tracks the short end of the yield curve. That's what the Federal Reserve directly affects. And you can see this acceleration to the upside started around May, June of this year. And that's when the Fed was getting super hawkish. That's when they saw inflation as a huge problem. They were going to have to raise rates by 75 basis points. Then they did that 4 additional times. So the bond market has really been a key driver of risk off this year. We haven't seen a worse year in terms of bond market since at least the 1970s. That's where that's how far back my data goes. Now, here's the Nasdaq 100 year to date, and some standouts here. So Amazon down 50%. Anytime you have one of these huge mega caps down this much, including Apple, by the way, down 27%, just really weighs on the indices. Nvidia down 50%. And when you look at some of the winners here, a lot of those are concentrated in the pharmaceutical space. So some defense being played here, and also Chinese stocks. You look at Pinduoduo, that is a Chinese e-commerce giant. That's up 39%. That is the best performing stock of the year, largely because China bottomed a lot earlier. They took their pain over a few years prior, and the reopening story is what's really captivating investors' attention so far. Just taking another look at an important sector, we're going to call this the disruption sector. This has to do with the ARC innovation components, and most of these, it's just too ugly to recap. We've been doing this all year long. Coinbase is the worst off, down 86%. Roku down 82%. Shauna.
Certainly a lot of red on that board. All right, Jared, let's talk about what this could mean for the year ahead. We want to bring in Julian Brigden, Macro Intelligence 2 Partners co-founder and president. We also have Ed Siddell, EGSI Financial President and Chief Investment Officer. Ed, let me start with you, just in terms of, I guess, your takeaway from all the selling that we've seen over the last several months.
Well, it's really not surprising. As the economic data continues to come around, everything is trending to the negative side. We just saw the index for the leading economic indicator come out, and it was worse than expected. It was supposed to be -0.5, and it wound up being -1 for November. And, as that's a story by itself being that bad. However, one of the major variables for the LEI was the stock market. And as we know, that rallied in November. So it'll be interesting to see, what the LEI looks like for December going into 2023.
Ed, just thinking about recession probabilities for the new year, what camp are you in?
Honestly, I think we're going to be in a recession. I think it's going to be deep. I think it's going to be long. And a lot of it has to do with debt. I think it resembles a lot of what happened in 2008, just the amount of debt that we have, because, the Fed said that we hit an all-time high, 16.5 trillion in consumer debt. And part of that was we added 1.27 trillion in consumer debt just within the last 12 months. So I think it's going to get a little bit ugly before it gets better, but it's going to provide some really good opportunities.
Julian, what do you think? Do you agree?
So I think if I look at it, I can see us dipping into recession probably the end of Q1, beginning of Q2. As for the debt, I'm not sure it's clear yet. I mean, I think part of the problem, and this is work that we've done internally, really does depend on the stock market. The stock market has a huge correlation with the employment market. The Fed must weaken this employment market. So my concern is at some point, maybe in Q2, they step back a little bit and we find there's resilience in this equity market. It's not my base case, but you may. And if that's the case, then we're going to get this little pause and the economy will rebound sometime in the second half, but the Fed will end up going again and hiking again. And that's my biggest fear for next year. I mean, as I said, I think Q2, we probably move into recession, but as for the depths, I don't think it's clear yet.
Well, then, Julian, how does this play out in the stock market? I know you're comparing the current market to the epic we had about 2 decades ago with the fallout from the dot-com boom. What does this portend?
So, look, I think we're in kind of, if you go back to the dot-com bubble, it was actually a rolling bear market. Right? We all think of the Nasdaq back in March of 2000. But the S&P held up for another 6 months till September, and the Dow didn't really go until May of 2001. I think we're in that kind of end of 2000 period where the money is rotating out of the S&P and into the super safety stocks that you can see. And I think these days that's akin to money coming out of the FANGs and going into some of these other sectors, these very safe sectors. And you can see it now. The US is breaking down. I mean, things like Apple are breaking down against the S&P. The broad US equity market is breaking down versus the rest of the world quite materially. And I think that could be the single Achilles heel of the US. We've lived off foreign inflows that have funded our current account deficit for the last decade plus. And if that money starts to go home, then the rotation into the rest of the world and the rotation into other sectors, most notably the one that we really love, precious metals, is going to be enormous. And this could take, we could see the US underperform for a decade.
Let's go back to the last thing that you said, because you said it was going to get uglier before it gets better, but that potentially does provide some opportunities. Where would those opportunities be in that scenario?
I think those opportunities are basically abroad. I really don't think they're in the US. You can get exposure in the US via certain sectors that are very heavily exposed to the overseas market. And as I said, I think in the commodity sector, I think this could be very much a period that we saw from sort of 2002 to 2008, a repeat of that time of period, as opposed to what we've got used to in the last decade, which was the only place to be in the world was the US, and the only place to be within the US was tech.
Ed, what about you?
Yeah, I agree. Commodities, that's probably going to be the hidden gem. Precious metals, even agricultural. Energy is definitely going to play a big part in it. But, I agree as the devaluation of the dollar occurs, I think a lot of the good buys are going to be overseas and not in the U.S.
All right, we got to leave it there, but a big thanks to you both, and thanks for joining us on a Friday before New Year's. Enjoy that, by the way. All right, coming up next, Elon Musk's Twitter drama takes a toll on Tesla investor sentiment, and analyst weighs in on what it means for the stock in 2023. And Apple is not immune from the beating big tech is taking on Wall Street, but see if a rosier future is ahead. Stay tuned.
Got some breaking news here. Disgraced FTX founder Sam Bankman-Fried will likely plead not guilty to fraud charges. That's according to the Wall Street Journal. Now, Bankman-Fried faces 8 charges, including fraud, money laundering, and campaign finance offenses. Bankman-Fried is set to be arraigned in New York next week after being released on a $250 million bond.
And after leveraging many of his shares to fund his purchase and restructuring of Twitter, many investors are left wondering what Elon Musk has in store for Tesla. Our next guest has some ideas on what steps a billionaire could take to course correct the EV maker in 2023. That would be Wedbush Managing Director and Senior Equity Analyst Dan Ives joining us now. Dan, snazzy yellow gear. I could imagine what that's for, but we got to talk some tech first. What can Elon do in the new year?
Look, I think first off, it's naming a CEO of Twitter. I mean, that's really been what I'll say is an albatross on Tesla stock, is Musk running Twitter and Tesla at the same time. I think that's the first thing. I mean, rip the Band-Aid off, name a CEO, don't let this drag on too much longer. The second, I mean, he's talked about it, but it's been Pinocchio, boy that cries wolf, but stop selling stock. I mean, he's used Tesla as his own personal ATM machine, whether it's a 10b5 plan, but lay it out so investors know nothing is really coming around the corner in terms of a block of sale. And I think the third is just laying out conservative numbers in January, not sky high given the macro. Those three, along with some of the others we laid out, I think that is a stock that could go meaningfully higher. But Musk created a 5-alarm fire. He's the only one that could extinguish it.
Dan, 2 other things stuck out to me, 2 other of your points here. New additions to the board, also buybacks. Why do you see that as key for confidence here going forward?
I think the board, from the street perspective, it's viewed as sort of a rubber stamp board. You need more independence. I think that would really ultimately bolster the street's comfort level in terms of what's going on with Tesla. Because as we've seen, Musk, it's been a Cinderella ride since 2017-18. But right now, it's been a black eye moment in terms of the Twitter situation. I believe it's 70% of the sell-off that ultimately is really Musk Twitter fiasco driven. So I think a board and having more, I think bolstering that with executives would be a very important step in the right direction.
Dan, we know that Elon Musk borrows heavily against his shares of Tesla. Is there a price point or a situation where that ends up in some kind of death spiral and significant margin calls for Mr. Musk? Yeah,
I think that's a little more bark worse than the bite. I don't really see that unless the stock goes meaningfully lower than here. I think there's some guardrails that they put in place there. But look, right now for Musk, I mean, that's really been the frustration, is that Tesla fundamentally, even in this macro, I mean, next year, let's call it a stress test case, 35-40% growth. That's still extremely impressive in this macro. But the Twitter situation, it's a nightmare on Elm Street that doesn't end. And I think that's why Musk, even we've talked about some of the political, the Twitter situation that we've seen, that's not what you want when you're selling to the masses.
So Dan, let's take a step back here and talk overall about tech, because I know you're out with a recent outlook for 2023. Apple was your favorite overall tech name for the new year. Lots of concern there, or questions I should say, about demand heading into a possible recession here in the U.S. Of course, also a slowdown on a global scale. Why do you think Apple is the strongest pick?
Well, look, first off, right now, I think overall tech and even Apple, I mean, the New York City cab drivers bearish in tech and Apple. So I think a lot of bad news is baked in here. And in my opinion, demand continues to be strong. 3-to-1 in terms of demand to supply. I think some of the parts is a stock that's $175, $200. And I just view tech as under-owned as I've seen since 2009. You want to own the high quality tech. And that's why when I look at a name like Apple, you look at a name like Microsoft to play cloud, you look at a name like Palo Alto to play cybersecurity. To us, I believe tech stocks are up 20% over the next year, even though many are yelling fire in a crowded theater going into 2023.
And Dan, just sticking with the mega caps here, your thoughts on Microsoft down a similar percent as Apple this year, 28 versus Apple's 26 or 27. So in terms of the mega caps, these are the 2 least dirty shirts in the laundry basket. Wondering what your thoughts on the software producer Microsoft are for the new year.
And Jared, that's a good example. I mean, I would view Redmond as a rock of Gibraltar. I mean, you look at spending next year, we think ultimately it's 6-7x IT spend. I mean, cloud, we're still less than 50% of the way through the cloud. That's the best pure play way to play the cloud, in our opinion. And clearly, you've seen risk assets get sold, but I believe Microsoft, when you look at that from what I view from a valuation perspective, stress test fundamentals, and what I view is probably the best management team in enterprise. I'll bet on Microsoft at these levels, and I think that is way oversold in our opinion.
Dan, what about the FTC, though, seeking to block Microsoft's acquisition of Activision? And I bring that up just overall as regulations could potentially be a risk for the sector here in the new year and, of course, the years ahead. What's your view on that?
Well, I mean, it's a Game of Thrones between Redmond and FTC, but they're not backing down. I do believe Microsoft ultimately wins that battle and does get Activision in their trophy case. And it's not just Microsoft. Others in big tech are watching it, because this is sort of a battle, almost a sort of courtyard battle that's happening. And I believe it unleashes more M&A in big tech. Big tech, I think, as well as strategic and financial M&A, I see a tidal wave of M&A happening to tech, especially with what we see a lot of these valuations, what they're reflecting.
Dan, we've been listening to you the whole time you've been talking, but we're a little confused because we know you're a big Penn State guy. They had the Rose Bowl coming up this weekend, yet you're in Michigan colors. What's going on?
Yeah, and we'll be at the Rose Bowl this weekend. I have a lot of family at Michigan, so I'm representing the Go Blue going into what I believe is probably a 2-touchdown win versus TCU.
You've heard it here first. We'll see whether or not you're right. Dan, it's always great to have you on. Thanks so much for joining the show, and Happy New Year.
Thank you.
All right, well, coming up next, the U.S. saying a negative COVID test is required for entry from China. We'll get a doctor's take on whether or not that makes sense when we come back. COVID cases are climbing. The CDC reporting over 400,000 new infections in the U.S. this week alone, and over 100 million cases have been recorded now since the start of the pandemic. Yahoo Finance's Anjali Kamlani here with the latest. And Anj, certainly alarming, concerning here, seeing this case count rise so quickly.
Absolutely. And we know that, of course, it is the winter season, so respiratory viruses, will take flight. We saw the triple-demic, really impacting hospitals earlier. So now with the new rise in cases, concerns about what is happening in China in particular. Right now, we're looking at 100,000 cases, more than 100,000 cases per day as of yesterday, and that's according to the latest numbers. We do know that so far, no serious climb in deaths, but we have seen hospitalizations. And then, of course, going back to what's going on in China, concerns about many different things. Number one, China not giving us the numbers of their daily cases. In addition, not really knowing whether or not the variants that are there that are driving the case rise are going to impact the U.S. It is important to note that we are still seeing some of those same variants here in the U.S., so it's not like they're not here already, but what the impact will be is still yet to be seen. As a result, the U.S. has joined many other countries in implementing testing requirements. France and the U.K. now joining that. And the U.K. just days after saying they would not be implementing any test on arrival situation. So all of that going into play for inbound Chinese travelers, and that is regardless of citizen status for here in the U.S.
All right, Anjali, stay with us because we want to talk about those new restrictions, because experts there are split over whether or not the new restrictions requiring that negative COVID test from travelers from China will be effective. Our next guest tweeted earlier this week, quote, "And does it make sense if we don't invest in widespread prevention effort?" Joining us now, we want to bring in Dr. Stella Saffo, HIV primary care physician and founder of Just Equity for Health. Dr. Saffo, it's great to see you again. It's been a while. So let's talk about the fact that you don't think it's going to be effective, or you don't think it's necessary at this point. Why?
So I don't think it's going to be effective if we're not matching the testing kind of requirements against prevention. And right now, the message that people are getting is that COVID is pretty mild. It's pretty harmless. Some folks who are immune compromised will die from it, but everyone else will be fine. So you don't really need to mask. That is the take-home message. So it's a bit strange if we're then saying, oh, we're a little concerned about COVID coming from this particular country, but we're not telling people it's probably worthwhile to consider taking some preventative measures like masking. So that's my real kind of concern, is that if we're worried enough to be testing folks because we don't want more burden of disease from China, we should also tell folks we're worried enough that we think that you should be masking more.
And I know, Dr. Saffo, that, there have been a lot of discussions, especially among experts like yourself, about why the concern should be there, but also what the broader picture is. We are a largely, we do have that immunity buildup from both vaccines as well as infections here in the U.S. Like I said earlier, the variants that we are watching drive the cases up in China are already here in the U.S., have already had their time, and there are new variants already out there that we're looking at. So on the variants front, what are your thoughts there on, whether or not this could result in another concerning one?
I think the biggest concern is that the population in China is so high that with this kind of exponential spread of disease, it is very possible that we could see more variants. The second concern is that in China, it's not clear that we're getting all the sequencing data and the case counts that we need, just as you've mentioned. So if we know that it's a population where we could get new variants, and we know that we may not be getting the most data, it makes a lot of sense to me to go ahead and be cautious, which is what this move to test returning travelers says. I think the thing that's really disturbing, though, is for a respiratory virus, and we've seen COVID rates before vaccinations, COVID rates were super high and the kind of impact was deadly. We had thousands of people dying a day and we've gotten it under control. But if we're worried enough about new variants that we're testing people coming back from China, we should also tell the public now may be a time that's worthwhile for us to think about masking indoors. It doesn't mean we're going to mask from now until infinity, but until we get more information, now may be the time to mask while you travel. Now may be the time to mask when you're indoor in large crowds like public transportation, just until we know more. And I think the challenge here is that people are so tired of hearing about COVID, they don't want to do anything. But again, it signals to me if the government is worried enough to be testing, return travelers, then it's worried enough, I think, for us to kind of message, it's worth masking.
Yeah, I'm sure you're getting the same rolled eyes that I do when I talk about COVID still. But
Rolled.
Well, talk to me about that though. But is the U.S. prepared? I know there's been lobbying in Congress for more funds, and it seems like they did at least give the recent round of tests. But it seems like, broadly speaking, to your point of masking, we're not doing enough necessarily to really mitigate on the ground what could be another wave.
Yeah, and I know that even this message that I'm sharing with you of how I think if we're testing folks coming from China, we should mask, it's going to earn me so much vitriol on social media, because every time anyone posts about COVID and prevention methods that we can use, people are just full of hate at this point. They're so angry. No one believes that masking works, et cetera, et cetera. So I think that where the sentiment is coming from, where people are afraid to kind of say, the measures that we should be implementing, is that people are tired and the public doesn't want to hear it. It doesn't, though, preclude the requirement that we have as scientists, clinicians, public health experts to sound the alarm, to inform people, those who are not kind of the hardliners, I will never mask again, but people who are moderate, who say, and people say to me, my patients say to me all the time, Doc, what should I do? What do you think I should do now? I'm not sure, don't know what the, kind of public is telling me. What should I do? And they will do what we tell them because they want to be safe. And so I think that that's kind of where I'm landing is, let's not, sound one alarm that we're worried about what's coming from China without doing the work to really say, and here's how you can protect yourself. Not to mention that sounding it for China in particular increases anti-Asian hate, which has been a huge problem with COVID-19 to begin with. And so there's a lot of issues here that I think we really have to consider.
Dr. Stella Saffo, always great to have you back on Yahoo Finance. Thanks so much for joining us. And of course, our thanks to Anjali Kamlani as well. All right, well, coming up, many Americans fearing the R word, recession. Find out what you can do to prepare yourself for one when we come back.
Fears of a recession are looming across the country. Yahoo Finance's Jenna Herron joins us now with tips on how to prepare yourself financially in the event of a downturn. Jenna, what's the first thing people should do to get ready?
Sure. And you know what? Happy almost New Year to you, Jared. But yeah, so I know people are probably a little worried that there's a recession coming and what that might mean for their finances. So the first thing I think people should do is actually take stock of their financial situation. And I would actually recommend this regardless of whether you're worried about a recession. It's a great time of the year to really figure out what money is going in and what money is going out. So what is your financial situation? That includes what are your essential bills? So what do you spend on housing? Your car payment, if you need your car to get to work, your health insurance, your utilities, and food. Those are the essentials, right? You need to make sure you have money to always meet those bills. Then tally up your other bills. So how much do you spend on that other stuff? Like, going out, your credit card debt, your subscriptions, your streaming services, cable. These are kinds of expenses that can either be eliminated altogether or cut down. And it's good to know what those are. Then take a tally of your cash on hand. So what do you have in your checking account? What do you have in your savings account? Do you have any money floating around in CDs? So know what you have there. And then last, what are the other sources of cash that you might be able to tap? And it might be a little bit harder. So if you own your home, can you get a home equity line of credit or a home equity loan? Do you have a certain type of life insurance policy that allows you to withdraw money early or take a loan? What about your retirement accounts? Does your employer allow you to take a loan against your 401k? So you want to really gather a good picture of where your finances are and where you can go to if you run into trouble.
Jenna, we hear lots of talk about an emergency fund exactly for a time like this, when times get tough. I guess people want to know, and I'm curious, how much should people be allocating towards their emergency fund, and any tips if people don't have one and are looking to build one pretty quickly?
Yeah, emergency funds, really great to have. It really gives you peace of mind. The rule of thumb is to have 3 to 6 months of your expenses saved up. You want to be closer to that 6-month goal if you're a one income household. You can be at that 3-month goal if you have more than one person with making income. So, but here's the thing. That sounds like a lot of money, and it's really hard to get past that. So don't get overwhelmed. Start small by trying to save the amount of your largest bill first. So that would likely be your mortgage or your rent. So if you lose your job, you look in your emergency fund, you're like, hey, you know what? At least I have next month's rent or mortgage paid. And that gives you a little bit of a buffer. After that, then try to get 1 month of expenses saved up. So start small and don't feel discouraged that you don't have the whole kit and caboodle. Now, how do you go about building an emergency fund? It's almost tax season, guys, but you know what that means? A lot of people are going to get a tax refund. And that is a good chunk of money to put away to start your emergency fund. You might also get a bonus from work. That's another place where you can jumpstart that emergency fund. And if you have any side gigs or things like that, then you can start allocating some of that money to your emergency fund. So those are some quick ways to really build up those savings that you can tap in case things go wrong.
And Jenna, we've heard a lot about layoffs, mainly concentrated in the tech sector, but there are concerns as the Fed is raising rates that they're also going to engineer a recession. So if somebody out there is worried about losing their job, what advice do you have for them? What may be in their control?
Yeah, so I mean, I don't worry about, one of the things you can't control is if your company is going to have layoffs, right? So what you need to think about is how you can position yourself if you lose your job. So one of the things I would say to do is update your resume and your LinkedIn profile. And I would do this now before you lose your job, because there's going to be a lot of other things that you have to deal with after you lose a job. So you might not feel like doing, an update on my resume or my LinkedIn profile at that time. Don't let your network go stale. Talk with people, make sure you're asking about job openings other places. Just keep in touch with everybody. So if you do lose your job, you can tap them and ask them if there are any openings where they are working. The other thing I would say is to make sure your skills or certifications are updated before anything bad could happen. So take advantage of any new training that your company offers right now to beef up that resume, or if you have to take some classes to get some certifications up to date, make sure to do that before things go south.
Very important tips here for all of our viewers. Jenna Herron, thanks so much and Happy New Year to you.
Thanks.
All right, well, the theatrical industry climbing back from steep pandemic losses in 2022, although a complete turnaround is still yet to be determined. Yahoo Finance's Alexandra Canal joining us for the breakdown and what comes next in 2023.
Hey, Shauna, and if you just take a look at theatrical stocks, obviously noting the meme craziness that is AMC, you'll see pretty steep losses as this industry fights back from pandemic lows. We are still about 30% below 2019 box office levels, with ComScore estimating that domestic ticket sales will secure roughly $7.35 billion by the end of this year. If we take a look at the top 5 highest grossing movies of 2022, they're all franchises. Top Gun Maverick smashed 15-year-old records, secured $1.4 billion in global ticket sales to become the #1 title this year. That's followed by Jurassic World Dominion, with that Avatar sequel quickly nearing that $1 billion mark after just 2 weekends in theaters. Yet all of that still wasn't enough to get us back to those pre-pandemic levels. So the key for 2023 will be a more beefed up release schedule, more films on a more consistent basis. And analysts that I've spoken with have emphasized that the mid-range movies, films performing in that $50 to $150 million range, are needed to help fill in the gaps. Another thing to watch will be streaming platforms leaning on the theatrical window, especially as direct-to-consumer losses escalate. Even Netflix, which has been largely resistant to partnering with the box office, decided to show its Knives Out sequel in a very limited theatrical run over Thanksgiving week. According to industry estimates, that was a huge success, with about 13 million in domestic ticket sales after it played for just 1 week in 600 or so theaters. As a result of that, many industry insiders, including Netflix co-CEO Reed Hastings, said the streamer left lots of money on the table after it refused to commit to a wider theatrical rollout. We'll see if that strategy changes for Netflix in 2023. And in a similar vein, tech giant Amazon will reportedly invest $1 billion to produce 12 to 15 movies a year exclusively for theaters. That's another positive sign for cinema owners and a justification when it comes to the lucrative theatrical business model. So, the big question, will theaters fully bounce back to pre-pandemic levels in 2023? Probably not, but at least right now, it's a wait and see approach, and things look much better in the new year than they did in 2022.
Well, it's time now to take a look at what we're going to be watching next week in the markets. On Monday, guess what? The markets are closed in observance of the New Year holiday. Tuesday, it's manufacturing PMI and construction data. Wednesday, we get ISM manufacturing as well as the JOLTS jobs data in the morning. And at 2 p.m. on Wednesday, we get the latest Fed minutes. Thursday, we get the ADP employment report on the private market, plus initial jobless claims, and then a few earnings reports with Walgreens Boots Alliance and Conagra, Constellation Brands, all of those reporting before the market open on Thursday. Friday is the big one, the big jobs day of 2023, the first one of the year. Economists are predicting the U.S. added 200,000 jobs in December, with the unemployment rate remaining unchanged at 3.7%. Ahead of this, we got the FTX saga sparking a crypto sell-off. Kathy Woods tells us why she's still seeing opportunities in the space. Stay tuned.
ARK Invest CEO Cathie Wood is buying more of the crypto dip headed into the new year. Woods' firm bought $5.5 million worth of Coinbase stock on Thursday. Well, earlier this month, the famed disruptive tech investor told our own Julie Hyman what's still appealing about the crypto space. Let's take a listen.
I think what we're learning because of FTX is how much more important fully transparent, decentralized networks will be to financial services going forward. FTX, Celsius, 3AC were all closed networks, opaque systems. You couldn't see what was going on. And what happened as they were going down, the people who were on the fully transparent distributed networks were able to get out scot-free. They saw what was going on. There were margin calls for those who were over-leveraged, but the system worked. It didn't skip a beat. Those other companies went out of business. It's a little bit like 08-09. The old financial world is very opaque, not transparent. The new world that we're entering, and we do believe DeFi will actually get a boost coming out of this because it's so obvious now. Decentralized and transparent is the way to go. Those networks didn't skip a beat. All of the transactions were completed. And there are all kinds of metrics saying they're getting stronger now. It's very interesting to note that Sam Bankman-Fried, who has either committed gross negligence or outright fraud, he didn't like Bitcoin. He didn't like it. And why didn't he like it? It's decentralized, it's fully transparent, and he couldn't control it. He was trying to control the crypto world, master of the universe. And that was a recipe for failure. It's been most unfortunate because so many people have been hurt because of it. But I do think the big lesson, and even the newest SEC commissioner is saying, you know what, we really have to double down on this idea of decentralization and transparency and help to propagate this new world with the right kind of regulation. And it's not like they have to change regulations. As Brian Armstrong says at Coinbase, we don't need new regulations. We need clear regulations. And we certainly need more clarity from Gary Gensler at the SEC. And the other thing we need, I would submit, is we would have saved a lot of people from some of the catastrophe that FTX has presented them with something like a Bitcoin ETF, a regulated. Instead, a lot of people went offshore and then got carried away with it. So I think the SEC deserves some blame for what has gone on as well.
Cathie, can I sneak in one more, or do you have to run? I know you have another meeting you have to get to.
Yes.
Okay.
Yes.
Okay. You do have to go?
No, one more. I do have to go.
Okay, great. I want to ask you about Tesla. I just want to sneak in one on Tesla, which you still have a big position in, right? Man, Elon Musk has been busy, as he always is. And there's new reporting today that his bankers are considering replacing some of the debt he used to buy Twitter with new margin loans backed by Tesla. There's also some reporting out of China that the production there is actually slowing down. Is your faith shaken in him at all in terms of running Tesla? Is there anything that would shake your faith in him in terms of how Tesla's doing?
So on Tesla, the end demand is the end demand. And in Shanghai, it does appear perhaps that high end demand is giving way to a little bit of low end from a pricing point of view demand because of the economy there. Yet in thinking about Tesla's positioning, now that supply chains have loosened up, I believe what's going to happen is Tesla is going to be at the forefront of being able to drive down costs and prices so that this idea of electric vehicles moving into the mass market is going to start to take root. Tesla is very aggressive at cutting costs and prices once we get out of this situation. So no, I'm not worried. In terms of manufacturing, which is the gating factor here, we need new plants as EVs scale. We believe from 8.5 million units globally this year to perhaps 60 million in 2027. We think Tesla is going to be at the forefront of that. And so our conviction there has not diminished. Elon's main role at Tesla right now is moving it towards an autonomous taxi platform, which we think will happen in 2024. I think he thinks it'll happen next year. I think he is as focused as ever on that. And yes, he has had his hands full with Twitter. I think he's surrounding himself by the right engineers, and he's going to bring in new leadership. I notice, I mean, I don't know if this is going to be the case, but Brett Taylor, who just left Salesforce.com, was on the board of Twitter and certainly understands that company. He's an incredible operator. It'd be interesting to see him come in. I don't know if that's going to be the case at all, but I know he's going to surround himself by the right business leaders. He's not going to be running that company on a day-to-day
Kathy,
basis.
just to be clear, you think Brett Taylor would be a good choice as CEO of Twitter, is what you're saying?
When I saw him step down, now there are others stepping down as well, so maybe there's just an outright restructuring going on there. But I thought, he was on the Twitter board. Maybe, you never know. This is not even a rumor. I'm just saying he's the kind of person that I believe Elon Musk is attracted to and will surround himself at Twitter.
So Kathy Wood initially saying that on our air a couple of weeks ago. We have certainly heard from a number of analysts since then saying that Elon Musk should hire somebody else to run the day-to-day at Twitter and focus on Tesla. But Jared, it's certainly been a tough year for Kathy Wood. A number of her investors or followers that have also invested in some of those growth names, some of those tech names that have been beaten down by higher interest rates. And when you look ahead to 2023, we're certainly starting to see more and more analysts lower the expectations of some of her largest holdings, that including Tesla, which you was just talking about, and Zoom. So it could be another rough year for her. I don't know. We'll see.
Yeah, let's take a look at the Wi-Fi Interactive real quickly here. Just want to show you the ARK Innovation ETF holdings. There's Tesla front and center, well, left and center. That's down 36%. But you take a look at some of the other, by the way, this is actually month to date. That's a terrible month for Tesla. Let's go to year to date. Here's what we were looking at around the close. Coinbase down 86%. I think there's going to be M&A in some of these names. I wouldn't be surprised. I don't know about Coinbase, Robinhood. That's another stock that Kathy Woods has been buying. You can see that's only down by about 54% at the top. Roku, I've said for years, potential takeover candidate, maybe by Apple. That hasn't come to fruition. Not seeing Netflix here, but Netflix another potential takeover target, and simply because the prices are cheap. So maybe companies are going to go shopping this year. A little bit too much uncertainty this year, but with a little bit more certainty next year, perhaps we'll see some of those deals close.
We will see. Kathy Wood scooping up more shares of Coinbase this week. So we'll see how that plays out for her in the coming year. All right, well, coming up, many Americans are focusing their New Year's resolutions on their finances. We're going to tell you about them when we come back.
We are one day away from New Year's Eve, and people are starting to share their New Year's resolutions. 50% of consumers, that's half of you, plan to make resolutions this year, and that's according to a new survey out from data analytics company Numerator. 53% of those making resolutions plan to focus on finances.
All right, well, here are some of the areas that they're focusing on. 57% want to save more money in general. 48% want to track spending more carefully. 43% want to reduce their spending. Paying off loans also makes the list here, and soaring prices have clearly impacted these consumers. 57% of them are making financial goals because of inflation. 48% are being cautious of a possible recession. And Jared, when you dig down into what we're doing by generation, more than 60% of millennials, my generation, making a resolution that they are choosing to focus on their finances because it has been such a tough year. We know many millennials have been saving up or have bought a house over the last couple of years. They certainly have been driving the housing boom that we have seen since the start of the pandemic. So the fact that we could be headed in for a larger economic slowdown, many of them making the smart choice, I might add, by prioritizing their spending.
Yes. Personally, I make resolutions at any time of the year, not necessarily New Year's, but I'm a big believer in resolutions, and finances are top of my book for the new year. Just getting a handle on things. I'm going through my credit cards. It's amazing some of the services that I can cancel, and I'm looking forward to doing it.
I need to do that, actually. I haven't made any New Year's resolutions, so I'm going to take that tip from you because that is something I can certainly do in the new year. All right, well, we asked you guys, Yahoo Finance, looking for the big market predictions of the new year. We wanted to hear from you, so we asked what stocks you were most optimistic for in 2023. We're looking for some good news after what has been such an awful year for the market. We got a resounding consensus. You can see it on your screen. Tesla. Jared, people are ready for Tesla to turn things around. Ending the day, you can see up just about 1%. But for the year, that stock looks ugly.
Yeah, I don't know. I can see the bull case for Tesla. I can see the bear case for Tesla. There are so many dynamics, and it doesn't even all hinge on Elon Musk. I mean, we talk about this because it is a cult of personality for sure, but I think a lot of it still hinges on the macro environment. I think what the Federal Reserve does, if they crack under pressure in a few months, or if it takes to the end of the year before they pivot, or they don't pivot at all, I think that's going to be a bigger determining factor.
You got to put on your hat. What happened to it? I saw you struggling with
Yeah, well, this broke. That's why I was struggling.
Okay,
I mean, I could put that on there. We got other hats here.
We also wanted to ask you about your outrageous finance predictions for the new year. One response caught our eye. Ethereum passes Bitcoin in market cap value. Jared, this is an interesting pick to me, and I think my takeaway overall from what we've seen play out in crypto is the fact that Bitcoin and Ethereum have been relatively resilient when you think about all of the implosions, the chaos, the crisis that has really been swept up within that sector.
Yeah, it's only down about 65%. You compare that with almost 100% for some of the other tokens there. I wouldn't be surprised if that actually happens. I don't know if it's going to happen this year, but I think in 2 or 3 years, Ethereum just has more bigger base case use. So I do think that eventually happens. Yeah.
I was going to say, go ahead. You take it away first.
So here's drum roll. Guess what my prediction for 2023 is? It regards the Federal Reserve. And here's the Federal Reserve's balance sheet. It's coming off of the highs of $9 trillion. And right now it sits at about $8.5 trillion. I think the Fed actually blinks. They pivot before it reaches $8 trillion. So based on current runoff, about 100 billion or 85 Bs per month, that's going to take until May, June. I think the Fed only has about 6 months before it cracks under the weight of this contraction.
All right, my prediction is for Peloton. I think Peloton's going to be a takeover target. Who is going to buy them? We've been talking about this year. I think it's going to be Apple. We know Apple has been placing a larger emphasis on the fitness portion of their business. They see growth potential there. Given Peloton's performance since they hit that high during the pandemic, they're looking more and more attractive. I don't know. We'll see. All right, Jared, toast to you. Happy New Year. Happy New Year to all of you guys out there. We will see you in the new year. We hope you have a wonderful, wonderful new year.